Imagine waking up tomorrow and hearing that your neighborhood bank might run out of money. Not next month, not next year, today. You rush to the bank. Your neighbors are already there. The line wraps around the building. Everyone wants their money back immediately. The strange part? The bank might not actually be broke. It simply doesn't have everyone's money sitting inside the vault. And within a few hours, fear spreads faster than facts. Businesses stop borrowing. Investors start selling. Perfectly healthy companies begin collapsing. While almost everyone is desperately trying to save what they have, a small group of people quietly starts buying. Not because they caused the panic, but because they still have something everyone else suddenly needs: cash. By the time the panic is over, some fortunes have disappeared.
Others have become even larger. This is the story of the Panic of 1907 and how one financial crisis quietly changed who owned America. If you enjoy documentaries that uncover the hidden history of money, power, and the institutions that shape the modern world, subscribe to Empire and Capital, because history rarely disappears. It just hides inside the systems we stop questioning. To understand why this happened, we need to travel back to a very different America. It's 1907. There are no smartphones, no online banking, no Federal Reserve. If a financial crisis breaks out, there isn't a powerful central bank waiting to step in. No emergency press conference, no instant bailout announcement. If panic spreads, the country is largely on its own. And that's exactly what made this moment so dangerous, because money doesn't stop working all at once. It usually stops working one frightened person at a time.
Imagine your entire town has one giant toy box. Everyone places their favorite toys inside for safekeeping. But the person watching the toy box notices something. Most children only come back for their toys once in a while. So while the toys are sitting there, he lends a few of them to other children. Those children promise to return them later. Everything works perfectly, as long as only a few kids ask for their toys at the same time. Banks work in a surprisingly similar way. When you deposit money, the bank doesn't lock every dollar inside a giant vault forever. Much of that money is lent to families buying homes, businesses opening stores, or farmers purchasing equipment. That's how economies grow. But there's one important catch. If everyone suddenly demands their money back on the same day, even a healthy bank can run into trouble. Not because the money disappeared, because it's already out helping someone else. And in October of 1907, that's exactly what began to happen. It started with a risky attempt to manipulate the stock of a company called United Copper. The gamble failed spectacularly. Investors lost millions. Almost overnight, rumors spread that several financial institutions connected to the deal might also be in trouble.
Whether every rumor was true no longer mattered. People believed something was wrong. And once enough people believe a bank might fail, they all begin doing the exact same thing: running to get their money before everyone else does. That simple human instinct would trigger one of the worst financial panics in American history. And it would reveal a lesson that still shapes markets today. Because during every panic, someone is forced to sell, and someone else is waiting to buy. Once the rumors started, something remarkable happened. People didn't wait for proof. They didn't study financial statements. They didn't call the bank and ask if everything was fine. They simply joined the line. Because when money is involved, people often copy what everyone else is doing. Imagine you're walking through a park. Suddenly, hundreds of people start running. You don't know why, but chances are you'll start running too. Not because you understand the danger, because everyone else seems convinced it's real. Financial panics work the same way. Fear spreads much faster than facts. One of the biggest targets was a company called Knickerbocker Trust. At the time, trust companies were becoming increasingly popular. People trusted them with their savings. Businesses trusted them with their money.
And investors trusted them to keep the financial system moving. But trust is a fragile thing. When rumors connected Knickerbocker to the failed United Copper speculation, customers began lining up outside its doors, not to invest, not to borrow, to withdraw everything they had. Within hours, millions of dollars flowed out. The company couldn't keep up. Knickerbocker Trust suspended operations. And suddenly, people began asking a terrifying question. If one trust company can fail, who's next? Here's the strange part. The panic wasn't spreading because every bank was bankrupt. It was spreading because no one knew which institutions were safe. Imagine your teacher tells the class, one lunchbox has spoiled food. She doesn't say which one. Now, every child opens their lunchbox at once. The problem isn't just the spoiled lunch, it's everyone reacting at the same time. That's exactly what happened in 1907. Money didn't suddenly disappear. Confidence did. And once confidence vanished, banks stopped lending, businesses stopped borrowing, factories slowed production, workers lost jobs. A banking panic had become an economic crisis. Today, when financial markets panic, people usually look toward the Federal Reserve or the Treasury Department. But in 1907,
neither could solve the crisis because there was no Federal Reserve. So instead, America turned to one man, J.P. Morgan. By then, Morgan was already one of the most influential financiers in the world. He had spent decades financing railroads, industries, and some of America's largest corporations. More importantly, he had something almost no one else possessed: the confidence of Wall Street. As panic spread across New York, Morgan invited the country's leading bankers to his private library. Behind heavy wooden doors, far from newspaper reporters, they examined balance sheets, compared accounts, debated which institutions could still be saved and which ones could not. It almost sounds unbelievable today. One private citizen helping coordinate the rescue of America's financial system.
Not because he had been elected, not because the Constitution gave him that authority, but because there was no central bank capable of acting quickly enough. For a brief moment, the stability of America's economy rested inside one library. But even as Morgan fought to stop the panic, something else was happening. Stock prices were collapsing. Businesses were running out of cash. Owners who had spent years building successful companies suddenly faced impossible choices. And that's when the real transfer of wealth began. As panic spread across Wall Street, something strange began happening. Perfectly good businesses started becoming incredibly cheap. Not because their factories had disappeared, not because their railroads stopped existing, not because their workers suddenly forgot how to do their jobs. They became cheaper because their owners desperately needed cash. Imagine owning a beautiful house worth $500,000. You will want to sell it, but tomorrow the bank is taking it. Someone offers you half its value. You know it's a terrible deal, but you take it anyway. Not because the house is worth less, because you need money today. That's what panic does. It changes prices long before it changes value. This is one of the most important ideas in investing. During a financial panic, most people don't sell because they want to. They sell because they have to. Some need to pay back loans. Others have investors demanding their money. Some businesses simply need enough cash to survive another week. They're not making careful investment decisions anymore. They're trying to stay alive. And when thousands of people are forced to sell at the same time, prices fall much faster than the actual value of the assets. Now, imagine you're standing in that same market. Everyone around you is selling. But unlike everyone else, you still have cash. You don't have debts coming due. You aren't being forced to sell anything. Instead, you can choose. You can wait, or you can buy. This wasn't true for many Americans in 1907, but it was true for a small number of wealthy investors, financiers, and institutions that still had access to money. While others were trying to survive, they were looking for opportunities. Think about it this way. A railroad doesn't vanish because its stock price falls. A factory doesn't stop existing because investors panic. A profitable business can still make useful products even while its shares collapse. The buildings remain, the machines remain, the workers remain, the customers often remain. What's changing is the price someone is willing or forced to accept today. And that creates opportunities for buyers who can afford to wait. This is why financial panics often reshape who owns the economy. When weaker businesses couldn't raise enough money, some were reorganized, others merged, some sold valuable assets. Investors with cash were able to purchase stakes in companies, finance struggling enterprises, or acquire assets at prices that would have been unthinkable just months earlier. History rarely remembers every individual transaction, but it remembers the pattern. During periods of panic, ownership has a way of flowing toward those with liquidity. Not because they're immune to fear, but because they're one of the few groups still capable of acting when everyone else cannot. By the spring of 1908, the worst of the panic had finally passed. Banks reopened. Businesses slowly returned to normal. The stock market stabilized. On the surface, America looked like it was recovering. But beneath that recovery, something had quietly changed. Many businesses now had different owners. Investors who had been forced to sell were gone. Those who had enough cash to buy during the panic now controlled a larger share of the economy than they had just months before. The crisis hadn't simply destroyed wealth. It had redistributed ownership.
The panic of 1907 also exposed a much bigger problem. The United States had relied on one private banker to help stop a nationwide financial collapse. Most lawmakers agreed that couldn't happen again. A modern economy was simply too large to depend on private meetings inside one man's library. In the years that followed, Congress studied what had gone wrong. Bankers debated possible solutions. Economists proposed reforms. And in 1913, the United States created the Federal Reserve. Not to prevent every financial crisis, no institution can do that, but to provide emergency liquidity when fear threatened to freeze the financial system. The Panic of 1907 had revealed a weakness. The Federal Reserve was designed to address it. More than a century has passed since 1907. The buildings are different. The technology is different. The markets move faster. But human behavior has changed very little. In 2008, millions of Americans watched home prices collapse. Businesses struggled, banks failed, investors panicked. Yet many long-term investors with available capital purchased assets at deeply discounted prices, expecting that markets would eventually recover. A similar pattern appeared during the short market decline in early 2020.
Different crisis, different causes. The same question. Who has the cash when everyone else needs it? When people talk about financial panics, they usually focus on what was lost. The money, the jobs, the businesses, the headlines. But history suggests there's another story happening at the same time. Every panic creates two groups: those who are forced to make decisions and those who still have the freedom to choose. That freedom often comes from something surprisingly simple: cash, liquidity, time. Not because those things guarantee success, but because they create options when options become scarce. The Panic of 1907 wasn't just a banking crisis. It was a lesson in how ownership changes during moments of fear. The railroads didn't disappear. The factories didn't disappear. The businesses didn't disappear. What changed was who owned them. And that's a pattern that has echoed through more than a century of financial history. The next time you hear that markets are crashing or that investors are panicking, don't just ask what's losing value. Ask a different question. Who's buying? Because history suggests the biggest fortunes often aren't built when everyone feels confident. They're built when almost everyone else is afraid. If you enjoy documentaries that uncover the hidden history of money, power, and the institutions that shape the modern world, subscribe to Empire and Capital. Because history rarely disappears. It just hides inside the systems we stop questioning.